Hey everyone, welcome back to Corporate Decoder, the place where we decipher the truth behind corporate filings. And let me tell you, this latest report from Keysight Technologies is a real page turner, especially with those big acquisition plans they've got brewing. We're diving into their July 31, 2025 quarterly report. And folks, things are definitely moving and shaking over at Keysight. Let's get right into the heart of it, the numbers. Okay, first up, total revenue for the 3 months ended July 31, 2025 hit $1.4352 billion. That's up about 11% from last year. And for the 9-month period, it reached $3.956 billion, an increase of 7%. This growth is pretty solid and shows they're selling more of their test and measurement gear. Breaking it down, their Communications Solutions Group, known as CSG, saw revenue up 11% for the quarter and 8% for the 9 months. This segment is doing well, likely fueled by demand for next-gen wireless tech and big defense projects. Then there's the Electronic Industrial Solutions Group, or EISG, that also saw a nice bump with revenue up 11% for the quarter and 5% for the 9 months. This business seems to be benefiting from the AI boom and growth in areas like semiconductors, even though the automotive sector is a bit slower. Now let's talk about the bottom line. Net income for the quarter took a bit of a hit, dropping to $91 million from $389 million last year. The company explains this was mainly due to a big tax benefit they got last year, which wasn't repeated this time, plus higher operating costs like people expenses, tariffs, and integration costs from acquisitions. For the 9-month period, net income also decreased from $680 last year. The company explains this was mainly due to a big tax benefit they got last year, which wasn't repeated this time, plus higher operating costs, like people expenses, tariffs, and integration costs from acquisitions. For the 9-month period, net income also decreased from $687 million to $617 million again, largely due to those one-time tax benefits last year. Speaking of taxes, the provision for income taxes swung from a large benefit of $176 million last year to an expense of $50 million this quarter. This big swing is a major reason for the lower net income this period and highlights how sensitive their net income can be to tax items. Looking at profitability, their gross margin, the difference between revenue and the cost of goods sold, stayed pretty much flat at around 61.7% for the quarter. However, the 9-month gross margin was down slightly to 62.4%. They're blaming tariffs, rising labor costs, and an unfavorable mix of products for this dip, but luckily they've managed to offset some of that with better pricing and higher sales volumes. Their investment in the future, R&D spending, was up 11% for the quarter and 9% for the 9 months. This shows they're still betting big on innovation to stay ahead of the curve in fast-moving tech markets. Selling, general, and administrative expenses were also up, reflecting ongoing acquisition integration costs and general higher operational expenses. This is pretty typical as companies grow and acquire new businesses. Now let's glance at the balance sheet. Total assets grew to $10.651 billion from $9.269 billion at the end of last fiscal year. This increase is driven by a significant rise in cash and cash equivalents, which more than doubled to $2.636 billion. They've also taken on more debt, with long-term debt jumping from $1.790 billion to $2.533 billion. This is likely linked to their funding strategies for those acquisitions we'll talk about soon. Goodwill also saw an increase, reflecting recent acquisitions, which is common. Goodwill is basically the extra amount paid over the fair value of acquired assets, and it suggests they believe these acquisitions will bring future benefits. Accounts receivable actually decreased, which is a good sign, meaning they're collecting money from customers more efficiently. And that cash pile we mentioned, $339.7 billion in total cash equivalents and restricted cash. A big chunk of that $759 million is actually restricted cash tied up in money market funds for a planned acquisition, showing they're getting ready for some major moves. Speaking of acquisitions, they're still planning to buy Spirent Communications for about $1.463 billion, and another deal for Synopsys Optical Solutions Group is also in the works. These are big moves that could really reshape the company. Now, no corporate report is complete without a look at those risk factors, and Keysight is no different. They're worried about global economic conditions like inflation and possible recessions, which could hit their sales. Trade tensions and tariffs, especially with China, are a big concern as they can increase costs and disrupt supply chains. Geopolitical turmoil and regional conflicts also pose risks to their international operations and market stability. They also highlighted the constant pressure to innovate and bring new products to market quickly. If they fall behind on this, they risk their solutions becoming outdated. Currency fluctuations are another concern given their global footprint while they do hedge their exposure. These programs aren't perfect and significant currency swings could still affect their financial performance. And finally, in terms of leadership moves, a few key executives, including the CEO, have adopted new trading plans under Rule 10b5-1. These plans allow insiders to sell company stock at predetermined times, meaning it's not based on non-public information, and that's generally seen as a good governance practice. So what's the big picture here? Keysight is showing solid revenue growth driven by demand in sectors like 5G, AI and defense. They're actively managing their costs, and while net income took a hit this quarter, it's mostly due to one-time tax items last year. Their ambitious acquisition strategy is a clear focus, which explains the increased debt and restricted cash. The risks they've outlined are pretty standard for a global tech company, but the interplay between economic conditions, trade policies, and their need for constant innovation is definitely something to watch. Overall, they seem to be navigating a complex environment pretty well with a clear strategy for growth. Oval tech company, but the interplay between economic conditions, trade policies and their need for constant innovation is definitely something to watch. Overall, they seem to be navigating a complex environment pretty well with a clear strategy for growth. Alright, that's our breakdown of Keysight's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.